Good morning, ladies and gentlemen. Welcome to this morning's webinar entitled Valuation Trends in the European Hotel Market. It was Stephen Covey who once noted, if there is one thing that's certain in business, it's uncertainty. Well, I think 2025 is probably shaping up to show us a year of true uncertainty, disruption, and where traditional norms are being challenged. I suspect there are very few of us who can accurately forecast the next 3 years, let alone 2025. So how is all this impacting on valuations across the European hotel market? On a positive note, many do forecast global GDP growth this year. Europe is forecast to do 1.3% growth, which is up from 0.7% last year. So how is this impacting on investment strategies, and how do European investors feel? If the trade wars and tariff impact over a sustained period, what will be the ramifications? A JP Morgan economist only last week noted that there's a 40% chance of recession in the US. Is this likely? And how will this impact? And how will it make the European investors feel as this carries on? Question mark. Of course, even in the UK, there's a lot of concern as well with the NI increases and tax hikes coming, and you can feel the angst around operators. So much seems to rely on consumer confidence, but consumers are facing no few increases in costs themselves as we hit April. Higher water bills, higher energy costs, higher council tax, and an economy that's not growing. And yet we still want them to spend money. So again, the threats and the opportunities are right around us. Many questions to be considered and answered. And we're honored today to be joined by a range of leading experts who can provide a light on all of this for us. So we welcome them and we welcome you. I hope you enjoy the next hour and a half. I think it should be absolutely fascinating. If you have any questions during that period of time, please do ask through the buttons at the bottom, and we will strive to make sure we answer every question and get back to you as well. We always like to start these sessions with some polls to get a feeling of how you are viewing the market at this point in time. So if we could ask for your thoughts at this moment. Izzy, can I ask you to bring up the polls? Question 1. What do you expect hotel values in Europe will do on average in the next 12 months? Increase by 10%, increase by up to 10%, stay the same, decrease by up to 10%, or decrease by more than 10%. Number 2, in your view, what is the biggest challenge facing hotel owners and operators in Europe today? Macroeconomics, geopolitical issues, the reluctance of guests to travel, operating cost pressures, finding and retaining staff, compliance with ESG and zero requirements, or something else? Question 3, to what extent do you perceive tech-enabled services to have an impact on hotel profitability and therefore values in the near future? Strong positive impact, some positive impact, little or no impact, some negative impact, or strong negative impact. Number 4, if a hotel does quickly implement changes to comply with ESG, net zero requirements, what impact do you foresee? Potential investors will not invest, lenders will decline to finance, valuers will reduce its market value, some guests will refuse to stay there, some staff will choose not to work there. All very interesting. Izzy, do we have the results coming through? So in question 1, people seem to believe that valuations will stay about the same over the next year, 61%, and 30% see an increase by up to 10%. Yeah, that's interesting. In question 2, in your view, what's the biggest challenge facing hotel operators and owners in Europe today? Macroeconomics, 40%, and operating cost pressure, 46%. I think that's, again, very logical. And finding and retaining staff at 10%. That's becoming a bigger issue all the time. Question 3, to what extent do you perceive tech-enabled services to have an impact on hotel profitability? 61% some positive impact and 18% some positive and strong positive impact. That's playing a bigger discussion piece as well as we go through this year. And question 4, if a hotel does not implement changes to comply with ESG, How will it impact? 59% potential investors will not invest. Lenders will not, and 68% of lenders will decline to finance. It's really interesting, isn't it? And values will reduce its market value. Thank you so much. I think there's some really interesting indicators there for where we sit in this marketplace at this moment in time. So let's see how the next hour and a half goes and the kind of insights we gain. Can I now welcome Sophie Perret, Managing Director of HVS, to come and join me?
Hi, Chris.
Good morning, Sophie. Good morning. I wish you well. I'm looking forward to this. Good luck.
Thank you. So let me go on and share my screen. There we go. All good. You can see my screen? Fantastic. Good morning, all. Welcome. Delighted to be sharing our findings in terms of value changes in Europe in 2024. My agenda for this presentation today, oops, hold on, wrong screen. There we go. My agenda for today will take us through an overview of transactions in Europe to start with. We will look at investment trends in 2024, what the value changes were in 2024. Sorry, I'm getting ahead of myself. What the values changes are on a per region basis. So we're going to get a little bit more detailed into that valuation trends. And then we're going to take a quick look at what we think is on store for 2025. Quite a task. So we will start with a bit of an overview of transaction volumes in Europe. And here I'm looking back to almost 2 decades of transactions volumes. And as we can see, 2024 was in fact a very good year. Transactions were up some 62% over 2023. I mean, obviously, 2023, as you can see, that was not a great year. It was the second worst year since 2020. And we need to go back quite a bit, more than 10 years actually, to find transaction volumes that were as low as those of 2020. In contrast, 2024 is closer to the volumes of strong years like 2016, 2018, we can see on the graph. And I think it's worth noticing as well that since the pandemic, we've had most years being either close to or surpassing the average level of transactions for those 18 years that we are tracking on this graph. And I think I really kind of wanted to highlight this because I think it's quite remarkable in light of all the headwinds impacting this industry over this period in time. So if we look at 2024 in a little bit more detail, we'll see a number of metrics that I'm presenting here that are all very positive, or green positive numbers. If we look at the total volume of transactions, like I mentioned just before, 62% up on 2023. The number of hotels that transacted, the number of rooms up by 54%, 49%, the average price per hotel. The average price per room at 215,000 euros is up 9% on 2023 and is also higher by 5% than the average price per room achieved in 2019. So all those arrows pointing up quite nicely there for a very positive year. Now I want to bring your attention to those 2 points at the top end of the right-hand side of the slide, which show the arrows pointing down, and that would be for inflation, which finally started to come under control, and that was towards the later part of 2023. And on the back of that, central banks were able to start decreasing interest rates. So those are 2 very important arrows coming down that allow all the other arrows as well to come up. And interestingly enough, if I was to show you exactly the same metrics for 2023, you would see that the arrows are all pointing in a different direction. Inflation was still up, interest rates were increasing, and all the metrics in terms of transactional volumes were down. So quite an upbeat image for 2024. And where was the activity in 2024? In this heat map, we can see that the UK is actually by far the most liquid market in 2024. These are total transactions, both volumes and single assets. At 6.2 billion, this is 36% of the total volume of transactions taking place in the UK, and we've estimated that around 2/3 of that total is portfolio related. So that's a very, very consequential number. I'll get a little bit more into the detail of that later on. Second place comes to Spain, which has been very liquid ever since the pandemic. And you can see the total volume there are 2.5 billion, so substantially below that of the UK. France comes third, 2 billion. And then we have Germany, Italy, just over 1 billion each. So very, very stark difference there from the UK to all the other markets. Now, portfolio transactions doubled year on year in 2024 compared to 23. They're still far below the peak in 2019, but they did represent about 40% of the total volume of transactions for 2024. And that's above the typical average where it's more around 1/3 or thereabouts. And I just wanted to point out to a few of the big portfolio transactions that took place during the year. There was the 33 Village hotels purchased by Blackstone. Starwood Capital bought 10 Edwardian hotels. There were 18 Accor branded hotels purchased by Ares, 66 travel lodges, and also Pandox buying 3 residence inns in the UK. So as you can see, lots happening in the UK there. And when we look on a city level, actually London came out also by far as the most liquid market within Europe. They traded 3 billion euros in assets. And that, just to give you a little bit of the notion for how big that number is, the 5 markets following London all combined get to about 3 billion. So that's a massive difference for London there. When we're looking at single assets rankings, then Paris comes on top, 1.4 billion. And out of that 1.4, actually, there's 3 big hotel transactions that make the bulk of this, or at around 800 million, at least half of that amount. And we have the Mandarin Oriental in Paris, we have the Hilton Opera and the Pullman Tour Eiffel, those 3 very significant assets. London comes second, 1 billion, and then we have Madrid and Barcelona, which are pretty close together in terms of volume. And now I didn't list them here, but I thought it was interesting that if you were to continue with the next positions, Venice comes next, and then there would be Athens. And I thought that's kind of interesting because out of this list of single assets ranking, and I'm mentioning 6 cities, 4 are in Southern Europe. So I think that's quite telling. And in terms of some of the investment trends we've seen in 2024, very significant activity, both buying and selling from private equity at 8.6 billion in total. They were 315% higher than the volumes they transacted in 2023, so substantially above. Owner operators just down from 8 billion. Also very active, 90% more transactions than in 2023. Institutional investors were net sellers. They were still very careful around purchasing anything on the back of still lingering high interest rates. And where is the money coming from? Well, a little bit as usual, the bulk of the money is obviously continental. Europe supplies about 2/3 of the total volume. We do see slight decreases in Middle East proportion of the money invested into Europe. It was around 9% in 2023. This is now down to 4% in 2024. And on a very different dynamic, North America has actually seen its percentage investment increase from just around 7% in 2023, so pretty modest, to 21% in 2024. Very substantial. And then last thing on the slide, I wanted to draw your attention to the activity on a quartile basis. Portfolio activity was very, very heavy on the first half of the year. And you can see Q1 and Q2 in 2024 being very heavy in terms of the volumes transacted. Q2 was particularly busy there compared to 2023. There is the odd Q3 where activity is actually quite modest, is even below the levels of 2023, and then there's a pickup again in Q4. But that portfolio activity was predominantly a H1 phenomenon. And on to values. What you can see here is the trend of a sample of 31 markets that we have checked historically in terms of value changes across Europe. our conclusion is that on average, we're around 2% up in 2024 compared to 2023. Now, obviously, this is an aggregate of 31 markets, so there's lots hiding in this 2%. And I thought I would just give you a little bit of a sense. We're going to go into the details later on. But at this point in time, just to give you a bit of a sense, if you look at the statistics that I put on the right, then you'll see that around 70% of the markets that we survey in our analysis, sorry, that 70% is between around 0% growth or really flat to up to 4%, so fairly modest gains. And then we have the other 30%, which is quite nicely distributed at the two ends of the distribution curve as it would be, and 16% have gained about 5% or more, whilst 13% are showing a decline in values. So what is driving those changes in values in 2024? Occupancy obviously plays a part. It's been, across the board slightly up in most markets. Of course, leisure continues to be an important driver, but there is also those markets that are more dependent on corporate activity, business groups, and what have you. We've seen a slow improvement of these segments as well across the board, and whilst they might not move the needle so much on an ongoing basis, they do create compression nights, which actually then help to drive rates during those periods. So those types of activity and those business groups are particularly important to hotels, and we've seen a little bit of an improvement on those. Germany is a case in point. So in terms of average rate, there is, for those markets, there are those compression nights that I just mentioned. But what we see happening the most is actually still leisure and more peripheral markets, I would say, around Europe, which are benefiting from that rate growth at the moment. And there is a bit of a sentiment that these markets are benefiting from sort of displaced demand, so a demand that will have visited more core European markets during 2022, 2023, and are now looking for more value for money, as it were, and are exploring new destinations, as it were. Profitability has been stable. Inflation finally cooled off a little bit. Payroll pressures remain. There's a bit of a more stable situation when it comes to energy costs, well, at least for the moment. So all in all, we don't see enormous changes in the P&Ls. This is a fairly stable situation there. And on the back of that, the cost of debt has decreased. And this is obviously positive news for discount rates and for values. So an important element of that 2% is obviously driven by the decrease in the cost of debt. So to look a little bit at how the values have changed on a per region basis, the slight frustration here is 2024 is, all the values are quite close together there. So, it's kind of difficult to untangle really what's happening there. So there's a little bit of a blowout. Other years, there's been bigger differences between the regions. It's easier. But I need to highlight that Southern Europe, which is the region in Europe where the values have increased the most, this is an aggregate that includes Istanbul, and it's important to highlight this because Istanbul has done very well in terms of occupancy rate performance in Turkish lira, but the currency has depreciated quite a bit. There's high inflation, there's some economic problems. So inflation and the depreciation of the currency make it so that in euro terms, Istanbul values are down by around 10% or so. So that does bring my Southern European average down quite a bit. If I was to remove Istanbul, it's around 5% growth for that region. And then Eastern Europe has done pretty well, also above average in terms of region, whilst Western and Northern Europe are on average or below. And just to give you a little bit more context as to what is driving those differences between those different regions, when it comes to Southern Europe, I mentioned before this very strong momentum in those peripheral markets, as it were. So we have Athens, Lisbon, Madrid. Those markets are really going through an increase in performance, which is very, very strong, double-digit RevPAR growth, etc. There's a strong element of leisure driving that, but also the displaced demand that I mentioned earlier. When it comes to Eastern Europe, I'd highlight that inflation was very high in Eastern Europe, that inflation cooling off in this region is very significant. And I would say there's also a change in the perception for demand traveling to this region, which would have been concerned in the previous years that the Ukraine war was geographically closer to Eastern Europe, and that kind of prevented some source markets to actually visit. That is kind of changing. So this is creating a good performance actually for Prague, Warsaw, Sofia. It's also worth mentioning that these values still remain comparatively low. In terms of Western Europe, we have Edinburgh going crazy. The performance there is extremely strong. There are new routes that are being created, linking it to the US. So this is obviously going to keep on bringing that feeder market into Edinburgh. The prospects are very good for these markets. In terms of Paris and the Olympics, I guess it's a little bit of a mixed bag. Some have walked away. I mean, the event itself went really, really well, but I guess hotels have very different experiences of whether they did manage to come out looking very good or not so good. So I'd say overall the market is kind of slightly on the positive side, but it's not been a boom in RevPAR for sure. Not across the year, at least. And German markets, as I mentioned, there's a bit of a recovery there when it comes to corporate markets. So overall, those markets are seeing a little bit of an uptick in terms of occupancy and rate. When it comes to Northern Europe, Stockholm has been doing really well. The currency depreciation there means that you have to go shopping in Stockholm. This is the thing to do these days, and actually the market is doing very, very well. Amsterdam, on the other hand, that's been a little bit more challenged. The top line hasn't been brilliant, and there's this cost pressures, and that's not a great combination. So in terms of where the strongest value gains are, again, Southern Europe leads the way, and I'm just going to go clockwise a little bit here, starting from Athens, which has been the top performer and the only market that's actually grown by double digits in 2024, and that comes on the back of a very strong 2023 as well. So I think if we were to go back to just over a decade, really, 2012 or so, when we started talking about Brexit and so economic headwinds there, RevPAR performance kind of melted in Athens. So there's obviously quite a bit of a recovery that is taking place in this market as we speak, but it's definitely catching up, and it's a very interesting market. Lisbon is second best in our ranking. And Lisbon, like the rest of Portugal, is enjoying a moment of discovery, as it would be for some key source markets. And the US obviously comes top of mind. They really are starting to discover Portugal, and Lisbon is benefiting from this. Madrid, just next door, going through a very interesting period at the moment. The Madrid markets has seen the opening of true luxury hotels, quite a few of them over let's say 4 or 5 years or so. So the market is repositioning itself at speed into that sort of luxury leisure space, and it is very, very, very interesting point in the cycle for this market. In particular, Barcelona is also doing pretty well. Edinburgh, I mentioned earlier, this is very strong performances coming out of Edinburgh. So I think the prospects looking forward are very strong there. I mentioned Germany, where we see a good recovery in terms of RevPAR, both occupancy and rate performances are bringing some of these markets back. I mean, Munich is okay. They have their fair share of leisure. Frankfurt has been a very complicated market ever since the start of the pandemic because of its reliance on corporate demand. So it's good to see that there's a bit of a changing tide there. And then I mentioned Eastern Europe also doing pretty well. Prague, Warsaw, Sofia. Again, we need to highlight where we see it in terms of relative positions from a value per key for these markets. And so to illustrate that point on the relative values per key for these various markets that we are tracking, well, what can I say? Really, those bubbles, they speak a tone, don't they? And I would just say that there's room for improvement in some markets, and yeah, and some of those bubbles do look very gigantic. So outlook for 2025. So much to say. So I would start by commenting on Europe's fundamentals, and this is something I always repeat. I just think very, very strongly Europe is exceptionally well placed when it comes to tourism in a global context. And I think 1 in every 2 tourists that are roaming the world in 2024 kind of thought the same and ended up in Europe at some point in time. 53% of all tourists in Europe, and this is a statistics that is fairly stable across time. The arrivals in 2024, international arrivals, were 5% up for Western Europe on 2023, and they surpassed the 2019 level. So this is definitely great news. And again, I'd highlight Europe's culture, the sightseeing, the history, the gastronomy, incredible infrastructure. I'd say it's a fairly small continent if you look at it, and it's so easy to get from one country to the other. All this are, I think, very positive points that we don't want to lose sight of. On the back of that, I remain positive in terms of RevPAR outlook going forward. I would think that the gradual reversal of working from home policies will be helpful for those markets that have local hotels, depending also on that activity, the footfall around them. It obviously a big unknown is what happens to the US dollar in a very challenging world environment, because we have benefited from a very strong dollar over the last couple of years. The US visitation is about a quarter or so of the visitors that come into Europe. So a weaker dollar would certainly have consequences, you'd think. In terms of interest rates and inflation, the path for the moment remains pretty clear. The ECB lowered rates just last month. It's like the 5th or 6th time they decreased the base rate. Bank of England's path is, I guess, a little bit less clear in terms of the economic circumstances in the UK. But what could obviously derail this a little bit is what happens with trade wars. And from 1st of April, we're about to find out how those tariffs that get implemented into various European goods are actually going to have a repercussion, and whether we are seeing a return of inflation. Because if that was the case, then obviously that might change the direction of travel from central banks in relation to interest rates. So, yeah, so it's a challenging year ahead, but I think there are really interesting opportunities. We are in a context where we're sort of reinventing alliances as we speak, and the fact that Europe is focusing on self-reliance, I think, could be good for its economy, could be good for its industry, and good for industry and good for economy means good for hotels. So I would think that this is definitely positives that we need to be very mindful of. I'm quite positive about that. I mean, obviously, on the back of this, there are geopolitical challenges which are not likely to go away in the immediate future. And that brings me to the end of my presentation. Thank you very much.
Sophie, that was excellent. Thank you so much. Very interesting. Firstly, we have a question from the panel. Do your stats include Malta in the analysis?
No.
Thank you. And going back to obviously the outlook at the moment, because I think one of the really interesting things is this outlook at the moment. What's going forward is fascinating, isn't it? There's lots of opportunities, threats, and challenges. How do you really see it beyond? How can you go a little bit deeper on what you actually think about what's really going on?
So, well, I would say, and then again, the threats, the challenges, we don't know how this is going to pan out. I'd say we have to just be very mindful and try to mitigate any possible exposures that we have to certain source markets as much as we possibly can, etc. But there's little that we can do on that front. I would say the news emanating from, say, for example, Germany are very positive. Just a couple of days ago, they approved the spending package, which is very, very significant in terms of defense. The debt brake has actually gone. I think that we are living through a pretty momentous situation in Europe, and I'm positive that this should be, in the short and medium term, very, very good news for Europe, because we want to be a little bit more self-reliant, and I think it's going to be good for the economy ultimately. And again, a dynamic economy, I think, is good news for hotels.
Good. Thank you. Thank you so much. We had a question as well. Will we be sharing the presentations? Yes, we will be sharing the presentations afterwards as well. So look, our thanks to Sophie. Thank you very much. That was excellent. And now may I welcome Karen, who's going to introduce the panel. Good luck, Karen. Nice to see you.
Very much, Chris. And thanks to Sophie for a great presentation. So moving straight on to introduce our panelists today, we have Bettina Graf Parker, Head of Hotel Properties at Ariel Bank, Graham Smith, Managing Director at AlixPartners, David Kellett, Managing Director at Invesco Real Estate, Cash Gohill, one of the founding partners of Amante Capital, Paul Thomas, VP International Hotel Development at Marriott International Hotels, and Sophie will be rejoining us as one of our panelists. So could everyone please join us on screen, if you are not already on screen? Great. I think we're just waiting for Sophie. So let's get right into the question. So the key message that is coming out of the HVI, which is the Hotel Valuation Index, I'll refer to it in our session as the HVI, is an upbeat one, with economists generally predicting positive, if modest, global GDP growth for 2025. So do you agree with that conclusion broadly? And did any of the report's findings surprise you, or would you take issue with any of them, and why? I don't know, David, would you like to kick off perhaps?
Sure, thank you. Yeah, thank you, Karen. Look, I think the market sentiment is broadly probably a little bit upbeat, but I think there's a couple of issues I think on it. One is that the recovery, trading recovery across Europe has been exceptionally widespread from maybe what you might have expected, pre-pandemic, right? So we've seen market like Edinburgh, which Sophie mentioned, where the RevPAR is up, I don't know, 60% from pre-COVID levels. And of course, the German markets are still broadly underperforming. And this spread of recovery, to me, is a big influence. And then when you layer on top of that cost pressures, I think we could see, again, a sort of a bifurcation of the valuation spread. So it was interesting when you saw the kind of the poll at the beginning with, I think, 30% thinking, 6% thinking valuations stay the same, 30% thinking they're up sort of 0 to 10%. Nobody really saying they're going down. And but then you look at the macro environment, we've got very unstable geopolitical situation at the moment. I think on the whole, it's positive for Europe, particularly in the sort of tourists come to Europe and all those things. But I would just say it feels like still a relatively volatile market, and that probably in balance should put pressure on value rather than being positive for value.
Thanks, David. Would anyone else like to comment there? Graham?
Yeah, I'm happy to chip in there. I guess certainly what we're seeing with the various businesses that we work with across travel, hospitality, leisure, there is still some concern around how this year might play out. Whilst inflation is still in check, there's pockets of categories which are still seeing pretty high cost inflation levels. I think the consumer's been pretty resilient so far and kind of brushed off a lot of the concerns and the worries. But I think probably there is a greater amount of so it's negative news coming out at the moment with uncertainty. So yeah, I think that there is it feels as though as we head into 25, it's going to be more of a case by case basis. I think as sort of David referred to there, this sort of a rising tide has lifted sort of almost all boats really. I think we'll get down into sort of much more location specific considerations now, asset specific considerations, now that sort of general uplift is probably falling away.
Right, and on the subject of locations, the HVI says London has returned to pole position as the most liquid market in Europe, followed by Paris, Barcelona, and Madrid. Does this reflect your company's areas of focus, or which European cities or regions will you be focusing on for growth in the next, say, 2 to 3 years? I don't know, Paul, would you like to comment on that?
Yeah, I'd be
from
delighted.
A brand perspective.
Yeah, delighted to. And I think just reflecting on the transactions last year, it's no surprise really if you look at those 2 portfolio transactions with the Landmark transaction with some heavily weighted London assets in there with big box hotels, and then also take the I'm sure Cash will talk about it in more detail, but take the Adia estate, which also had some London hotels too. London continues to be a very high profile, resilient market, still doing very well with North American tourists coming in, European tourists. So we still see a lot of growth in London. We still think that travel patterns will continue on an upward trajectory, and business on the books is good. I think from the survey and from the report findings, it's no surprise to us that the Mediterranean markets are still very strong. I think that we've witnessed perhaps a slight cooling off of some of the markets such as Spain, now becoming overpriced. And so I think what you're seeing is funds, buyers chasing assets in markets like Greece and seeing new sources of buyers coming in. So for example, historically you wouldn't have seen some of the large PE firms looking at resorts in those markets, but that's certainly happening now, and there's still value to be gained in those markets. So I think for us, it's still the core markets of Edinburgh, of London, some of the regional gateway cities, and then in particular around the Mediterranean, looking at strong growth in those markets too.
Thanks, Paul. So Cash, would you like to come in there?
Yeah, no, absolutely. I think just going back to your previous question and how 2025 looks, what Paul mentioned there, I think is an influencing point as well. Hotels as an asset class have become a lot more attractive to, let's say, a wider audience of institutional money. So there's always going to be a question of supply and demand. So while where existing owners are sitting in their cycle of ownership, and there's a lot more, let's say, supply of funds chasing hotel opportunities, I think that's going to keep the transaction levels up and potentially kind of the valuations attractive as well. Again, second kind of Paul, in terms of the gateway cities are always going to be very attractive. The likes of London or Paris or Edinburgh. And I think what the two things that investors are always going to look for is kind of diversified demand. They don't want something which is a market which is reliant on just one aspect, and as well as kind of liquidity on the way out. So I think the strong markets are always going to offer that.
I know, David, we were talking about the interesting German market. Would you like to comment on that? Because Germany does seem to be a bit of a challenge for investors at the moment.
Yeah, I mean it is tricky for some. I think, I mean, maybe to Kash's point, the market, when you say London and Paris, I mean those are always going to be the most popular cities for inbound investment into Europe. I mean, they're just the biggest, most liquid markets, right? Paris though has underperformed over the long term. Last 10 years, there's probably, I mean, maybe I wouldn't call the Olympics a crisis, but most years they had some form of problem in Paris, which actually has made valuations arguably over the long term. They're still very expensive relative to all the other European markets, but it's not seen the growth in value that some of the other cities have seen. In Germany in particular, look, I think some of those markets are recovering now. So you had a good year for Munich last year, a little bit boosted by some of the concert. Adele was there for ages and everything. So some of them were very micro event driven. Germany's always driven by the trade fairs, and again, that activity is returning, but it's still some way off where it was in the sort of pre-COVID period. So, and you've got political stuff and all sorts. Maybe Bettina can comment more on it, but it's Germany. I think there is a lot of opportunity there. It's just a question of you've got to really pick the assets, right?
Yeah, just on that subject of the geopolitical trends, probably a good time to look at that. And the HVI notes inflation levels continuing to abate in Europe. But Sophie, you also highlighted the prospect of tariffs emanating from the USA, possible retributions resulting in global trade wars, etc. So how large do we think the influence of the American customer is on the current performance of the European hotel industry? I think, Bettina, you might like to give us your thoughts on that, please.
Yes, thank you. This is a question that I actually have on every hotel that we finance. How much US customers do we have, and how does that compare to pre-COVID? Because, we don't only finance hotels in Europe, but also in Asia and in the US, and we oversee the performance of all of these hotels from here in Europe. So what I see is that the European hotel industry is really outperforming the American hotel industry, particularly in terms of demand. Whilst Europe is growing in terms of demand, and then inflation is sort of a side topic in the revenue growth, in the US, demand is not back to pre-COVID levels, and the exchange rate has a significant impact on the people traveling to Europe. And that should not be underestimated. I mean, Sophie just mentioned Edinburgh and new routes from the US coming in, right? And that all of you, when you travel in Europe to the bigger cities, you see more American tourists than you would have seen prior to COVID. And that is something that causes compression, and that is something that could potentially change with the exchange rate, because it will not only potentially deter American tourists from coming, but it could cause Europeans to travel increasingly to the US again. So it would have a double effect. And we are always hopeful that this demand would by that time be replaced by the Chinese coming back, the Indian customer coming back. But this is something that needs to be monitored with the exchange rate, which is currently changing into the direction that we haven't seen over the last couple of years. So it's a space to be watched. On the other hand, there's articles out there that are saying that, you know, no matter how cheap it is, who wants to go to the US at the moment? Apparently from Canada, tourism to the US is down by 25% already. So that's a question that needs to be considered as well. So all geopolitical uncertainty and extreme volatility, I think, is something that, you know, overshadows all of our talks here, because we don't know, tomorrow it could be different.
Yeah.
I think I'd echo that, Karen. Just, I mean, as a North American company, whilst global, you know, a lot of our base, our loyalty base is coming from North America. And if I look at it from a development hat perspective, so the deals that were signed last year, we saw growth in North America, but certainly nowhere near as high an increase in deal volumes that we were witnessing overseas in international markets. So that is a pattern that certainly has been experienced in the last 12 to 18 months. We're not seeing a fall off in customer bookings from the North American market in the hotels in Europe yet, and I think the interest rates, the geopolitical situation is indeed volatile, is one to monitor, but it's certainly not filtering through just yet on the bookings to drive profitability in the hotels.
That's very interesting. So just
sorry, Karen, I was just going to say,
please, yeah.
American currency might have stronger impacts on certain markets, clearly, which is kind of strong American inbound. But there might be, and the question for me would be short-term volatility in kind of geopolitics. But if, let's say, there were to be peace in Ukraine, does that then kind of positively impact utilities and energy costs in the long run? Brings a lot more stability. And then that drives directly to costs that, a major cost in the P&L that we've been struggling with. So,
yeah.
Thank you. I think, and maybe one of the other points on that, I think, is that, if we look back over the last 10, 20 years, whatever, we've kind of gone from one crisis to another, right? Some economists refer to a perma-crisis as just being the state of the world that we live in, and we just have to kind of be with that. So we're talking a lot here about the short term, and actually the short term volatility for me creates buying opportunity, right? That's kind of that is in some ways the benefit of it, because you do have to go back to the long-term megatrends, and long-term megatrends for travel, and I think people doubted it in COVID, but we've seen the bounce back in travel post-COVID has just been exceptional. And it's a 50, 60-year megatrend post-Second World War of people wanting to get out and travel. And so the short-term geopolitical could be enormous, right? And that sort of goes beyond this call in terms of scope. But you've got to distinguish between short-term noise and long-term fundamentals. And of course, long-term fundamentals are great. Long-term is what should be reflected in the valuation, I think, more of the asset. But it's these short-term impacts which will go to, pricing at the moment, right? So it's some of this is a nuance, right, of the, but deep down we have a great sector, right, which is in long-term growth, right? But the short-term headwinds that are there, I mean, for me, are almost ones that create individual buying opportunities, potentially, maybe temper some of the. If you see some kind of things getting overheated, they maybe temper some of that, but that's probably maybe another perspective on it as well.
Thanks, David. I just wanted to pick up there on Kash's point about costs. And the index does note the persistent payroll pressures that have seen wage growth above inflation levels across Europe. But it also says that profit levels have been broadly static due to the gradual decrease of utility costs and otherwise generally stable expenses. So do you think the concerns about escalating wage bills have been overestimated, or is this still a concern for business? And is it time to perhaps reimagine the cost base?
Yeah, well, maybe if I can pick that up first and then I'll pass it around from here. But I looked at this in Germany a few weeks ago, and just over the last 5 years in the German market, the national minimum wage, which is a good indicator of sort of the cost base for most of the hotels, is up somewhere around 6 to 7% per annum over the last 5 years. RevPAR in Hamburg, which is best performing German market, was up 4% per annum. RevPAR in Munich and Frankfurt was up 1%. So if you run a, I don't know, Holiday Inn or whatever in those markets where you've got a very high proportion of your cost base, I'm sorry, I didn't mean to pick on Holiday Inn, but it's any mid-scale hotel, it could be a Courtyard, it could be anybody's really. You've got a big cost base which is under pressure. That's the biggest part of your P&L is the salary cost. And, you know, that does go to the need to reimagine cost bases. And you know, good operators will say, oh, we found some saving, we saved a head count, right? But that's not, you can only do that for so long. It's going to have to be a reimagining, I think, of the cost base. And I think this is where the brands can be really helpful, right? Because the AI and so these big technology changes which require major investment, frankly, that to me is really where the brands can sort of actually lead and give leadership here, because it's got to be a challenge for any owner operator. It's got to be a challenge for any sort of tenant company in a market where this trend, because that's a 5-year trend. That's not a one-off. That's not a 1 year kind of, there was a blip. That's like a long-term trend now.
I think that's something that we were discussing, and that's perhaps noticeably absent from the results of Sophie's very informative study, is the impact that brands have on values of hotels. So that it's very difficult to isolate and distill that, but I think there's a noticeable trend, and you can see it with transactions that have happened, such as the Residence Inn hotels in London, where you've taken a relatively unknown brand and plugged the hotels into a global system, and that has driven an increase in top line as well as bottom line, as David says, with benefits of economies of scale and costs. That branding impact isn't evident in the results of Sophie's analysis, but I'm sure there is an underlying improvement in the value of these hotels in the right markets where you attach a brand to them. So just an observation, I think, is trying to identify and distill the impact of what a brand has on hotel values.
I think that's a great question. I mean, how big a driver of value is the deal structure, and do you think you pay a premium for the absence or presence of a brand? Cash, what are your thoughts there?
We're in dangerous territory, but
yes, careful
here. Be nice, Cash.
A lot of what we do is value add, and one of the key levers we have, when you talk about how do you acquire something and transform it, is the brand. So we as Amanti are big believers in brands. So almost 90% of what we would look at would be with a view to kind of involve an international brand, and given all that we're talking about, the cost pressures, etc. One of the key aspects is, bringing in an international brand. The brands are really good at driving top line. So tap into the international markets, which you perhaps don't have access to if you're unbranded or, a brand which is focused on a let's say, smaller geography. So big fans of brand. Now, operating structure and contracts clearly has an impact on kind of valuation. And Paul might not like me for saying this, but a management contract is in my view at least, has less liquidity than, let's say, a franchised unencumbered asset. And maybe Sophie can tell us what deltas in cap rate she applies when she's looking at something which is unencumbered versus franchise versus management contract. So but believers in brand, it does impact value, how you're structured from an operating contract perspective.
Sophie?
No, certainly, certainly we do take a view in relation to hotels being encumbered by an HMA, how that compares to, say, a franchise or no brand whatsoever. Obviously, a vacant possession scenario is very attractive, as the most attractive proposition on exit, because this means the next buyer will be able to put whatever structure they prefer on the property. So it's kind of the ideal situation. I would say the franchise, the trend that has come to Europe from the US over the last 10 years or so to go more towards the model where you have a franchise and a third-party operator is quite a sort of a sweet spot, I would say. I mean, obviously, that becomes now a three-party entity that you need to feed, because there's the operator, the brand, and the owner. But at the same time, it does give you that flexibility, and third-party operators might just be more aligned with the owner in terms of driving the cost base and so forth. We do, to Paul's point, and same as Kash, take a view in terms of the potential for top line when there is a brand attached to a hotel, and in certain markets, this is very critical. And also, we don't want to forget that if a hotel needs to drive demand, occupancy, etc., and there is no brand, there might be a reliance on OTAs, which also do come at a price. So that is something that is sometimes a little bit less visible on the P&L, and it's the cost that is nevertheless there.
Bettina, what's your view on branded hotels versus unbranded, and how they impact on value?
In our portfolio, we have significantly more branded hotels than non-branded hotels. I think that's the first statement that I need to make. Whether managed by the brand or just franchised is a different story. There, I would say our portfolio, we can probably split it in like half or 1/3, perhaps, anything in between half and 1/3 being managed by the brand, and the rest being franchised. But we also do have non-branded hotels. So I think for certain properties, it needs to be considered that, you know, it is okay if it is not branded and does not have access to a brand reservation system, but a bit of a reliance on an OTA, because the property has created a unique standing for itself within a certain market. So we would also finance non-branded. We would even finance conversion from a brand to a non-branded. We have done this, but this needs to be with somebody that we have a good experience with in managing hotels and have a good history with in financing hotels.
Great, thanks, Bettina. Graham, did you want to comment there, please?
Yeah, so look, I guess, you know, my experience with these things, given that I often get involved in restructuring situations, it is often where, you know, things have gone wrong. Hotels have not performed at the level that was expected, and certainly in those scenarios, when we look at how, you know, you protect value, recover value for the lender, the investor, then new investors coming in definitely value the flexibility. And if something is encumbered with a, you know, very long-term management agreement, which is, you know, sort of highly robust, and, you know, a brand isn't open to modification, then, you know, that really does thin out your investor pool, who's often willing to come in on those situations. I mean, I must say, in my experience, generally when you do have a situation that changes need to be made, the brands are often very open to looking at what is the right structure given the situation of that hotel, because in the end, you know, the assumptions that were made as part of the underwrite and the initial investment, you know, obviously haven't come to pass, and mostly people are willing to look at, okay, well, should it switch from a management contract to a franchise? Should it switch to a different brand? What does that investment look like? So I think at the point in time when everything's going well, absolutely, I think that, you know, the brands are, you know, are positive to value, but I do think there is a need for that flexibility when things do go wrong, to avoid, you know, value being impacted more than is necessary.
And do we think there's a move away from management contracts, or that they're less desirable in some respects, certainly because they seem to be less flexible to the investor? Certainly we're seeing a huge growth in franchise agreement negotiations. Paul?
Yeah, sorry, Karen.
Yeah,
Maybe let Paul comment, and I'll comment after Paul, because he'll know firsthand better.
Yeah.
Well, I think we still value management contract agreements. So let's be clear that that is our bread and butter, and that's how we've grown as a company. But I think there's a growing realization that to grow as quickly as we need to, and to promote the types of brands that we are at the moment, which are more mid-scale, like 4 Points Flex or Courtyards, or Tributes and Autographs, where we're talking about conversion hotels, which is very much the cycle that we're looking at the moment. These are franchise models. This is the growth in which we're going to be experiencing, rapid development. We still do mandate HMAs on many of our luxury assets, and that's not going to change for the foreseeable future. But certainly we've had to change the way in which we work to become more flexible on brand standards, more flexible on operating support, and put that structure in place to enable our owners to grow as a franchise model. So I'm very supportive of that model going forwards. And I think the company has certainly changed the way in which it's doing its business on a day-to-day basis.
David?
Yeah, I think I was going to add to some of this is that there's absolutely no reason why a management contract shouldn't work, right? And so a lot of this goes down to, do you feel like you're getting value for money from said agreement, right? And remember, these management agreements are 20, 30 years, right? So Karen, can you imagine somebody giving you a 20-year agreement for legal services? You'd be over the moon, right? You think this was a great day, right?
Delighted, yeah.
You think absolutely brilliant day in the office if I got that, and so that is the big challenge of it, is then if there's an underperformance in management, which might not be underperformance in the brand, right? They're two separate things, because the brand, and Marriott will tell you, I think it's something like 60%, 65% of bookings go through their loyalty program. And that's tremendous, right? And that's tremendous growth from where it was even 5, 6 years ago, right? So there's a lot of value being generated by the brand. And when people talk about the encumbrance, and I remember when I was on the brand side, you hate the word encumbered, because you're like, well, hang on a minute, the thing adds value, it's not an encumbrance. But the management agreement is the encumbrance. And it's partly because you're tied into it for so long. And so when you go to things like brand standards, and I go back to that point about, salary growth, right? What you want from the brand is say, right, okay, I've got a problem, which is that my cost base is growing way faster than my revenue base. How are we going to use AI to fix it? How are we going to use, new technology to help us? How do we take, a staffing model of 20 to a staffing model of 10? How do we take away the brand standard that says you have to have 3 people on the front desk at all times, or whatever they might be? Because these things exist, and it's that piece, to me, which is the bit that needs to be unlocked. Because fundamentally, Cash would manage a property great for us, but so could Paul, right? And it's almost that it's the contractual flexibility and the alignment that we would get working with somebody like Amante or Westmont or whatever, all of the operating partners, typically because they're creating value and they're tied in with the property owner, is much stronger than with the brand, because the brand's objective is to maintain flag for 20 years. And so it's our alignment as a real estate investor is much closer with an operating partner that does a franchise, goes on sale because they get rewarded for doing so, essentially. And there's to me, it's that as much as I don't think that there's any reason why the big brands can't run a hotel as well as, Amante can run a hotel, or whoever else is running the hotel for you. It's just but the alignment is totally different, right? So it becomes and there's a ton of value embedded in this, right? Because the liquidity is worse when it's got the encumbered word attached to it. The yields are further out. People feel they have less ability to influence, right? Karen, you'll have negotiated more management agreements than the rest of us have had hot dinners, whatever the expression would be, right?
Management agreements. Yeah.
Yeah, and you'll know how they all are.
We're still seeing a lot of them actually, but not as many as we're seeing franchise agreements now.
Yeah, and as I say, I don't know that they're necessarily a bad thing, right? I think it's more that it's getting the right balance between the investor and the operator and the brand and all of these agreements, which is the key and is always the challenge as well.
Yeah, last word, Cash, to you on that. Do HMAs make an asset less nimble?
Yeah, exactly. I think you stole the words out of my mouth. I think David, the key is the alignment between the operator and the owner. And I know I'm saying this, many people have said this before, and it's the nimbleness and kind of the speed of reaction to kind of market forces which are impacting the hotel or the P&L. And oftentimes, brands are large kind of entities, and there's a little bit of time to work through the system. But maybe a question to you, Karen. A lot of when we're looking at acquisitions, we're looking at a lot of these management contracts which are negotiated maybe 10 years ago, 15 years ago, and they seem to be quite draconian in terms of the control provisions that they would have, the brands would have. But has there been a shift in the management contracts, which would then kind of, to align to David's point, a little bit more control for owners and reaction time, etc. So let's say if you looked at a management contract form, which is 10 years old, versus what you're negotiating now for brands or owners.
I think a lot of it depends on where the asset is and who the owner is. If the location is, I don't know, somewhere in the heart of London, you're looking at a boutique hotel, then the owner will be looking for a lot more control and often gets it. And that comes into things like termination rights and the like. But when you're dealing with different types of asset with bigger brands, I think you still have a big negotiation on terms in relation to flexibility. But definitely there's more flex in these than there used to be, I would think.
And we've seen, I mean, it's not widely available, but we've seen the requirement to offer on occasion the flip to franchise model. So
yes,
we would
absolutely.
go in on an HMA basis, but then within a period of time, there would be a right to flip to franchise. And I think that does drive additional value and gives a bit more flexibility, because ultimately the owner's looking for a shorter term management position on the hotel to be able to chop and change that operator to drive different efficiencies and performance.
And termination rights on sale and the like. Anyway, we could have a whole session on this topic. And for more chat on operator owner alignment, tune into my panel in Berlin. I think that's the only thing I can say.
It is Karen. It talk about drivers of value. Obviously, where you put the hotel is obviously like pretty important, but the contract that goes around it becomes the second biggest driver of value in the hotel. 100%.
I know that we've got some questions coming in, and I do want to leave some time for questions at the end here, and we've got a few more to crack through. So I'd like to look now at the M&A market. The index has noted an uptick in M&A activity, with European investors leading the charge. And as Sophie said, North American investors also making a comeback. Perhaps one for you, Graham. Is there still a disconnect, however, between buyer and seller expectations in terms of value? Why is there no volume catch-up?
Yeah, so I think there is still a slight disconnect here. I think because of all the things that have been mentioned with regard to what's happening in the world at the moment, some of those uncertainties. I think there is to a degree a look forward from new investors looking at a situation where they're factoring in some of these concerns and uncertainties, and a look back from the current owner who just looks at the recent trading and the figures that have been produced, and more often than not, they've been very positive figures. And it's interesting, you know, sort of Dave mentioned that sort of mega trend in travel. You know, we've certainly, you know, been involved in situations recently, and actually more on a lending side. You know, questions have been coming back from credit committees around, well, you know, we've had this post-COVID boom, and you know, everyone's been spending enormous amounts on travel. You know, is that really sustainable, or is that you know, another example of just some catch-up spend from consumers, and we're going to fall back to more normal levels? I mean, I happen to have the personal view that that's not the case, and that this is, you know, the consumers have shown with their behaviour that you know, travel, holidays, and you know, your business is hugely important to them, and they will sort of, you know, protect that against all other things. But I think having, you know, those a little bit of a disconnect on certain of those situations is still creating a bit of bid-ask spread in terms of value. Because I think if that wasn't there, I think we probably would have seen a much bigger increase actually in numbers of transactions. I think the UK, for example, has been, you know, dominated by some, you know, really material portfolio deals that have happened. But are we back to more regular levels of actually numbers of transactions if we move away from those portfolio deals? I'm not quite sure we are yet. So I think there is still a bid-ask spread there.
And Cash, are you finding that the competition is for deals is ferocious, or are you managing to get a clear run here and there?
I think there is definitely competition. So I wouldn't say that, you know, especially on the and goes back to kind of my, you know, supply of capital point. There is definitely a lot of capital waiting in the sidelines to kind of invest in the asset class, which means on the larger ticket size deals that we look at, I think there is definitely competition. People like scale. It's easier to finance in some ways. You know, it's attractive to kind of partner with brands. There's always kind of, you know, value add opportunities on, let's say, larger platform plays. I think where you know, on this, I do think there's a bid-ask spread still on, let's say, if you're kind of at the 50 million mark kind of ticket sizes on single assets, and exactly to the point, you know, that Graham was making, which is, you know, performance has been great there, you know, in spite of interest rates and you know, let's say financing pressures, there hasn't been real pressure from the banks on the current owners. So the expectation gap is definitely there.
Okay. I'd like to touch on debt funding. The index reports that interest rates decreasing will allow hotel owners to see more debt in the capital stack than has been evident recently, which would allow for potential reductions of more expensive preferred equity. And I'd like to ask Bettina there, are you seeing an uptick in acquisition finance?
No, if at all, slightly. The requests that we are getting are similarly acquisition as well as refinancings, and actually a larger majority are still refinancings. I think this is definitely still the trend. To us, or to me, actually, the numbers that Sophie presented with transaction volume being above the 18-year average was surprising from where I am sitting, because we definitely hear of a lot of assets that are being put on the market and also being taken off the market. So I think there is a lot of investors sitting on the sidelines that have been holding on to their assets for longer than they were expecting to, and they're waiting to put them on the market. With regards to debt funding and additional, you know, funding from funds and private equity to provide sort of a higher leverage point, I think given the interest environment that we were in and are currently still in certain markets, and particularly the ones we are active in with low cap rates, it's often very difficult to look at the debt serviceability, because we can all think, oh, values are going to be stable. We'd like to finance 65, 75, 80% of the value, yet that will not provide a coverage of interest, or even if you were to have amortization. So we're always capped by this, DSCR, ICR level that we would like to see. And whilst we get a lot of requests from alternative capital coming in and saying, hey, if ever you would like to partner up with somebody because you can't reach the LTV level, please consider us. We have never done a transaction like that because of the coverage that would exist on the interest or the debt service.
Right. And just one more question on that issue of debt funding for David, I think this time. What do you think banks are thinking about current valuations, and what might it take for banks to trigger a valuation and eventually potentially enforce?
Is that for me?
David.
You can both comment on that.
I can tell you.
Well, but I know that Ariel doesn't have any bad loans, so Bettina's doesn't have to worry about this part of the. And by the way, we don't have them either, so we're okay with that too. The I think, look, I mean, the hotel sector overall has done much better than a lot of other real estate sectors. And it's one reason that hotel share of transactions is up in the last year is actually because there's liquidity probably at what you paid for something versus if you bought an office 5 years ago, you probably don't have the same luxury. You've probably seen a very big decline in value. We haven't really seen the banks push a lot of stuff into, there are some sales which are effectively instructed by the lender because they're a bit over levered. And I think probably we start to see a few more of those come through over the next 12, 24 months. But, most people like me who come on these panels every year say, oh, there's going to be more distress, and then there hasn't been, right? So I think
you've been saying that for the last how many years, David?
Yeah, we've been saying it since the first, the first wave, the first lockdown. So this is great. It's going to be distress, and we haven't really seen any yet. And partly the recovery in trading has really helped in that front. So I think it's probably where you still see trading depressed versus 2019 levels, get my words out, is probably where you might start to see the banks squeeze a bit more. It may well be more tenant-led distress in markets like Germany because the real estate is probably owned by landlords with very low leverage, so it's probably not there that it comes through. But I think it probably just takes persistent underperformance and poor management for the banks, and maybe now they've gone through one cycle of extending and they don't want to go through another one. But I think there's enough people around who learnt lessons from the financial crisis as well, still probably to remember what happened in that situation.
Great, thank you. Conscious of time, we were going to discuss ESG. I suggest we do that in the Q&A because we've got a great question on that very subject from Joseph in our audience. So I'd just like to ask each of you in perhaps just one sentence to summarise whether you agree with HVS that on a long-term basis, hotels remain a solid strategy for diversifying core real estate portfolios. Perhaps not Sophie, because we've got some great questions for you, Sophie, on Edinburgh and sort of thing. So perhaps if I could ask the others, do hotels remain a solid strategy for diversifying core real estate portfolios?
Yes.
Yes.
I'm going to say strong yes as well. But...
Strong yes. Easy one to answer there. Paul, I'm sure you'll say yes.
I hope so, or else I'm out of a job.
Graham, what's beating them still? What's the number one on the list for investment, do you think? Is it still logistics?
Well, it used to be data centers until sort of the DeepSeek news came out and seemed to undermine that particular investment thesis. So I think this is one of the reasons why hotels sort of falls into such favor, is because it is so long-standing and there's a lot of historical data around you know, how it returns value.
Yeah, thank you very much, everyone. I'm now going to go on to the questions, and I'm going to start with Joseph Kutaya. I hope I pronounced your name correctly. So what are our observations on how climate change could impact hotel transactions and valuations, particularly in locations affected by extreme heat waves? Sophie, first of all, perhaps.
Sure, I'll have a go. These ones are always tricky. I think at the moment, really, when you're thinking Italy, for example, some of the markets like Sardinia, which have gone through some pretty significant heat waves in the last couple of years or so. I mean, is there a reinvention of how the hotel presents itself? I don't think. I think there's a change in customers' usage of the hotel. They will stay away from the heat during the worst times of the day, and it's the hotel's I wouldn't say responsibility, but the clever angle from a hotel's perspective would be to make sure that they have the facilities to actually accommodate those people inside the building, or provide them with alternative uses of their time with, you know, maybe
valuation. I mean, presumably things like climate change and ESG are definitely going to impact on
oh, they will. They will. I think the trickle into the valuation might come from various angles, because I would think that insurance expenses are likely to go up in markets where you're more prone to a fire or flooding or anything else. So then there is that angle there, of course. From a P&L perspective, and then obviously from a valuation perspective, you would be thinking about exit yields and factoring in some of the medium to long-term risks about sustainability of an asset vis-a-vis those macro climate events.
But compliance to regulation, I guess, in those markets, and also having stranded assets where you've got an owner that's not invested in them, and that's going to have an impact on your valuation, isn't it, Sophie?
Absolutely, absolutely. So the CREM models are becoming, for some investors, a very critical part of the equation when looking at an asset and deciding whether this is a reasonable investment option. And I think, David, you're very much into this type of analysis as a very coherent way to look at it. What is happening in the next 40 years? How do I need to move this asset from a current sort of brownish condition to something that's a little bit greener in which period of time, and how much is this going to cost? There's plenty of considerations around that.
Yeah, the capex on that, on just the net zero pathway, can be significant, and is part of the diligence we do on every deal that we've done. And it's ever since I joined Invesco, it's not just a last couple of years thing. It's been for a long time now. All of our investment committees, we would discuss that. The climate change question is interesting, and because we discussed that too. We have, I mean, a lot of it's data driven, but then you just you look at the news, and I mean, last year the horrible floods in Spain, and their surprise weather events are growing, right? And you can't really value them per se. I think, Sophie, you're right. It goes into insurance premium. I mean, these are insurance events, but they are more frequent, and they become a factor. Some destinations will become too hot. Some will, there's things that will play on people's minds over, and you have to look at these things in a sort of, again, it goes to long term, because we buy today, we might sell in 5-10 years time. Well, in 10 years, it could have moved again, and we have to factor all of that in.
But are you seeing preferential rates, David, on your hotels, or cash on your hotels from debt providers? I mean, I'm not seeing it from a senior lending perspective. I might see it on some hotels where they're talking about OPEX and they're giving some loans for smaller replacement items, but I don't think it's filtering through yet from the mainstream senior debt.
Oh, but Bettina, that's probably a good one for you to comment on as well. David, Bettina.
I think so, yeah.
Yes, it is filtering through. I think to make there's a lot of other questions, but yes, it's the short answer.
Yeah, I say green loans are usually a little bit cheaper than non-green ones if you can achieve them.
Yes, there is a benefit for it, but we can't say what exactly it is yet. We are refinancing our green loans with green bonds, and we cannot see a differential in the pricing on the market, but we can see that there is much better liquidity. And so for us, it's not necessarily only a pricing issue on the refinancing side, but also the perceived risk that you have in an asset that you finance today and you're going to be in it for 5 years that is not green. So there we would perceive an increased amount of exit risk, and that will be figured more as a, let's say, premium to the pricing rather than a discount.
Thank you very much. We've probably only got time for another couple of quick questions. Cash, were you going to comment there?
Yeah, very quick one. I
Yeah.
agree with all of this. But there's a, from an operating perspective, implementing ESG strategies doesn't result always in a lower operating cost. Sometimes it goes the other way as well. So,
Yeah.
that's always a consideration as we kind of do that. But it's a defensive thing that everyone needs to kind of do.
Thank you. There's an interesting question that's popped in from an anonymous questioner about development costs rising significantly since before the pandemic. Do we still see economy and mid-scale hotels as viable investments for new construction? Would anyone like to take that one?
I'm happy to sort of answer it by not answering it, if that helps, which is that across the whole, I look at investments across the whole real estate space, right? And developments coming through today, it's really just all about the yield on cost that you can generate. And so I've seen very few hotel out and out developments coming through recently. It might be because they think they can do better with, say, student housing or another use class, so it just depends a little bit. Some markets are restricted. There's some markets you can't develop hotels in. Some are getting harder again. So like Dublin is getting harder versus, it's not quite in Amsterdam, Barcelona levels, but it's getting more difficult. But it's really whether the land price has fallen enough for the development case to make any sense, and developers are struggling for financing. And that's why I'm sure if we ask Paul this question, he'll tell you all the deals he's signing. Way more of them are conversions, because you can buy existing buildings below replacement cost. You can put a conversion in and it's cheaper than building one. Right. And so why would you build one if it's cheaper not to? So I think these go in cycles, right? Go in waves, right? But at the minute, it's still a very difficult new development market. But Paul will see way more of that.
We don't really have time. This is a very quick comment, Paul.
Just that actually economy and mid-scale is where we are seeing traction in development of those that we are signing. So that segment of the pipeline is actually still proving to be viable.
Thank you. So we have got other questions. We do normally say that we'll try and answer them separately by email, if you could provide your contact details. We've been asked, Sophie, for example, for specific insights on Italy. What is causing the Edinburgh market to go crazy? What yields are we applying to well-located hotels in London and Edinburgh? A lot of very detailed, very interesting questions that I'm sorry we don't have time to delve into today. So I'd just like to thank the panelists, Paul, David, Cash, Graham, Bettina, and Sophie, and finally I'd like to pass over to Russell for his summing up. Thank you very much.
Thank you, Karen, and thank you all of you. Yes, we will pick up the remaining questions and send out some form of a written response. So please don't worry that your question will remain unanswered, but many of them are to be found in Sophie's publication, and we'll also send out details of how to get access on that. So in summary, and very, very quickly, you polled the response that said values are going to stay the same over the next 12 months. I guess the answer is watch this space, and we will come back in 12 months' time and see what happened. I'm not going to pick out any cherry picking from anybody's contributions this morning. They were all wonderful, and thank you to all of you for coming so willing to share your thoughts. But just a few comments that came towards the end. What we learned very much is that brands have resources to invest in AI to drive costs down, and let's see whether they will pick up that challenge. The debt requests, as far as Ariel are concerned and Bettina, mainly seem to be for refinancings rather than for acquisitions. We'll see whether that changes in the coming year. There are very few distressed hotels come to the market. So again, let's see whether that materially changes in the next 12 months. But above all, I think all of the panel, and as Sophie, our speaker, included, hotels remain a long-term attractive investment. And with that, ladies and gentlemen, I'm going to bring our webinar to a close. Say thank you for being with us and look forward to seeing you on the next occasion. Bye.